petroleum profit tax. Petroleum profit tax. But there is something I want us to look at very well. Petroleum profit tax, we can't just take it within a space of 2 hours and we conclude that we've completed or we've touched all areas under the petroleum profit tax. It's not possible.
Yeah.
So I want us to use this week and next week to complete the petroleum. I have enough questions, like 3 or 5 questions, past question, to work on next week. If at all we can touch all the theoretical, I can't even touch all the theoretical aspects. I will base majorly on the calculations. Let's work more on the calculations this week. Next week, we'll work on the theoretical aspects, and if at all, treat like 4 or 5 past questions. Then we are good to go to the exam. Or when we see a question of petroleum profit tax, we are ready to work on it and solve it all.
Sorry, before you continue, please.
Okay.
Hello, can you hear me?
I can hear you.
You're saying we should start with the theory. I mean, by theory, theoretical aspect. Please just give me, is it the calculation or the explanation?
The little of the explanation and more of the word calculation.
But are we going to understand if we just go to the calculation before coming back to the theory?
You will understand. The theory I'm talking about is just majorly on the, let me say, the function of all those departments.
Okay.
The function of the ministers, the function of the DPR department, the function of the the function of the NMPC, the objective. We can't be wasting our time on it. Where I only have this week and next week to cover everything on petroleum profit tax.
Okay.
You understand what I'm saying at all?
Yes.
Yes. So today, I will try all possible best to finish the income aspect, allowable and disallowable expenses aspect, work on the capital allowance aspect. So next, you'll be looking at the estimated aspect in form of what the returns, how they file their returns, and also more of questions like 3 or 5 questions. Okay, are you with me, class? Hello?
Hello, we are with you.
Okay, class, let's start petroleum profit tax. What do we mean by the petroleum profit tax? And why is it different from other aspects of the tax, the company income tax? Majorly, we have the company income tax and we have petroleum profit tax. We'll be looking at what aspect or what transaction we make an organization to be taxed under the PPT, which is the petroleum profit tax, and what aspect will be taxed under the company income tax. There is also a possibility in which a company will engage in a transaction, and that same transaction will be taxed under company income tax, CIT, and at the same time will be taxed under the petroleum profit tax. So if you see a scenario like this in the exam question, in which one question will relate to both CIT and petroleum profit tax for a single company. So how do we go about it? We also touch an area of the income. Income will be looking at the sale of the gas. How do we compute our sale of gas? If we are to look from the income in which the company derive their revenue from the sale of gas. Also, disposal of chargeable oil and sales of chargeable oil. If you see a question that has to do with posted price, adjusted posted price, how do we go about it? And at the same time, we'll be looking at the capital allowance computation and a different tax regime. We'll be looking at the production sharing contract, we'll be looking at the joint sharing contract, the risk operator, and the marginal feed operators. These are the things we'll work on today, and we'll be looking at the capital allowance computation, where there is a restriction on capital allowance computation under the petroleum profit tax. How do we go about it, and what do we do? If you see a question that relates to this. Introduction. In 1909, a German company called the Nigeria Bitumen Company began the search for crude oil in Nigeria. This license granted was for the exploration of petroleum at Araromi in the present day of Ondo State. The outbreak of the First World War in 1914 brought a halt to this adventure. The company did not resume operation after the war because of discouraging results during the operating period. In 1937, Shell was granted exploration license to cover the entire nation. The adventure again was suspended at the outbreak of the Second World War in 1941, only to resume in 1946. It was the amalgamation of this Shell and British Petroleum that gave rise to Shell Petroleum Development in Nigeria Limited, which eventually discovered oil in commercial quantity after a decade in 1956 at Olubiri in the present day of Niger's Delta of the country. The first oil field began production in 1958. Oil was discovered later in other areas of both Rivers and Bayelsa State. This is just telling about the metamorphosis about how the petroleum, exploration of the petroleum or crude oil started. When we look at the World War, the held by the World War, the Shell company, and the one that was discovered at Olubiri in 1915, which was the first one in which commercial quantity started, commercial quantity of crude oil. Plus, after this, we look at petroleum activity. This is an aspect we also need to take note of very well in the example. When we look at petroleum activity, we are looking at two major areas under the upstream and the downstream. Class, we are looking at two major areas under the upstream and the downstream. One of it will be taxed under CITA, company income tax, and one of it will also be taxed under the petroleum profit tax. So when there is an activity that is done on the upstream or the downstream, am I to tax it under the CITA, company income tax, or am I to tax it under the petroleum profit tax? Upstream activities. These activities relate to acquisition of license class, acquisition of the petroleum license itself, exploration, development and production of crude oil and gas, treatment of oil, processing of gas, as well as transportation and delivery of exports to terminal refineries and other processing plants. These activities are taxed under petroleum profit tax, upstream sector. Class, upstream structures, they involve the acquisition of the license itself, the exploration of the license, development of the crude oil, its treatment, and delivering that crude oil to the refinery. Class, we should note this. It is the delivering of it to the refinery. When it is now being refined at the terminal, it is not an upstream activities anymore. It is a downstream activities. And the transportation from the way, from this terminal, which is called the refinery terminal, to including the marketing of it, and also to the different sellers or different agents, as the case may be. These are other the downstream activity, but the upstream activities itself involve the exploration of the oil from the ground or from the ground or water itself, the treatment and the movement from the movement of that oil to the terminal where it will be refined. Class, where it will be refined. And any activities that involve the upstream activities has to be taxed under the Petroleum Profit Tax Act, Law of Federal Government of 2004. Downstream activities, as defined by the Nigeria Accounting Standard Board, now Financial Reporting Council, there are those activities that take place from the receipt of the crude oil into oil tanks or gas into petrochemical tanks to the transportation of the refined product to the final user or process of the product to the secondary users or secondary industry. These are downstream activities. Class, what he's trying to say is that immediately the petroleum operation or petroleum product has been extracted from the ground and it has been moved to the terminals, the upstream activities ended. The place it is being refined and it is being transported and marketed to the world, and the market activities take place to the final users or to the agents. Class, these are downstream activities, and any organization or company that involved in these major activities should be taxed under the company income tax and not the petroleum profit tax. Hello, class, are you with me at all?
Again, hello, please repeat that. Yes.
Yes. What I'm saying in essence is that petroleum activity is divided into two. We have the upstream sector and the downstream sector. The upstream activity and the downstream activities. The upstream activities, it involves the exploitation or the removal of that crude oil from the ground. Any treatment that will have to be taking place, that needs to take place, any process, any treatment process, including the movement to the refinery, that terminal, everything has to be on the word petroleum profit tax. Any company that involved in these activities are to pay tax based on Petroleum Profit Tax Act. But on the other hand, immediately the products are gotten to the refinery, place where it is being refined, marketing of the products, transportation of the product to the final users. Class, there are downstream activities and to be taxed under the company income tax. Any activities involving this are to be taxed under the company income tax. What I'm saying in essence is You might come across a question in which one of the company has an activity, it made income from where? From the sales of what? Export sales or sales of local sales of petroleum or gas products. And I have an additional information that says that part of the income he made on export or his local sales involves transportation from the refinery to the final user, or involve the refined product, refinery activities, or involve marketing activities. I have to deduct that amount that is derived from the marketing activities, or it derived from the transportation business, or it derived from the refinery business class, from the sales product, and that value will be taxed based on the company income tax and not petroleum profit tax. Hello? Hello, class?
Clear, sir.
Cleared. So in essence, I need to understand activities that involve petroleum profit tax and activities that have to be involved company income tax. So class, the regulatory agencies in the oil and gas include the who? One, the Nigerian National Petroleum Corporation, NNPC. This was established by Act number 33 of 1st April 1997. NNPC is the sole authority over the petroleum activities in Nigeria. NNPC too is subsidiary involved in exploration, production, transporting, processing of oil, refinery, marketing of crude oil and derivatives. FRS, which is the Federal Inland Revenue Service. The powers and duty of the FRS with respect to administration of petroleum profit tax are stated under Section 3 of the Act. The schedule specifically highlighted the powers and duties that cannot be delegated by the FRS under Section 3 BD, E, F, and so on. Majorly that for what? Grade 3, collection of the petroleum profit tax, the penalties involved, the rendering of the returns, submission of the returns, collection of the tax payment itself, activities that have to do with every petroleum profit activities involving tax, everything has to pass through the FRS and not the state revenue, irrespective of where the company resides or irrespective of where the company derives its income. It will be paid to Federal Inland Revenue. Department of Petroleum Resources, this is under regulatory agency. This is the arm of the Ministry of Petroleum Resources that is charged with the responsibility of regulation and supervision of operations under the license and leases in the oil and gas industry, which include exploration, production, and marketing of crude and refined products. Majorly, they are the department that give license, where we'll be looking at the oil exploration license or oil mining license. Subsidiary of the Nigeria National Petroleum Company. One, National Petroleum Investment Management Service, NAPIMS. This is the investment arm of NNPC, which administers NNPC. Share of joint venture operation. The Petroleum Product Marketing Company. This company has the responsibility of selling refined petroleum and refined products, which include gasoline, diesel, engine oil, grease, and other derivatives. This is just explaining the different segments or different departments in the NNPC that is charged with different activities of petroleum, that is charged with different petroleum activities. Plus, the central bank is also involved. Sale of crude oil is paid for in foreign currency into federal government designated bank overseas. The proceeds is then transferred to federal account in the Central Bank of Nigeria, and Federal Inland Revenue Service is notified through the payment advice. Plus, this is where the federal government comes in, the CBN. Any payment that have to do with export sales, that have to do with what? Export, international market, it will be paid through the central bank. Marginal field operators. Marginal field are field discovered by large oil international company or NNPC, and which as a result of other investment options were not developed or relinquished. Class, what he's trying to say is that every petroleum activities always involve huge capital, huge amount. It involves testing, rigging of oil, digging and rigging of oil, testing and discovering, doing a lot of tests for you to discover oil. Let's now assume that you've already invested a huge amount in a particular field, a ground or an area, a land, with the expectation that you will discover oil. Though you discover oil, but this discovery of oil is not in commercial quantity. It's not in commercial quantity. You now decide to abandon this field or this land. This is called marginal field. They are field that has been abandoned by large multinational companies that have been left unattended to or left without touching for over a period of 10 years. The indigenous company now decide to embark on this land Maybe they are not decided, their own discovery is not in large or big quantity like that. At least let me involve in something. So when this feed is not being attended by indigenous company, every operators of that feed is called marginal feed operators. On the other hand, what I mean by that marginal feed are the feed or land in which they have been abandoned by the international oil companies or NNPC for over a period of 10 years unattended to. Class, are you with me? Marginal feed are feed discovered by large international companies or NNPC and which as a result of other investment options were not developed or relinquished. This represents investment potential for small companies with workable operations. Such feed hold an estimated of 2 billion barrels per day. In its publication, the Department of Petroleum Resources mentioned that the federal government is favorable disposed to joint application and has set up a committee comprising of representatives of DPR, leaseholder, and financial advisors to assess submission with the aim of identifying companies most likely to be successful in operating marginal feed as well as further developing the Nigerian oil industry. What he's trying to say is that there will always be a word contract involved. Not anyhow company can just take up the marginal feed. If 3 or 4 companies decide to use that marginal feed, there will always write a contract to the world, to the NNPC and to the federal government through the NNPC. It's like a bid. They bid for it. So the best options will surely take over. Class, that will take us to aspects in which we'll be looking at calculation aspects, where we'll look at the different allowable and disallowable absences, the taxable income, the different licenses available under the petroleum profit tax. Before we move to this, allowable and disallowable, fiscal and tax regimes under the petroleum industry. I want us to look at this very well because this is also very, very examinable. The fiscal and tax regimes under the petroleum industry. One, we have a joint venture contract. What we mean by the fiscal regimes or the tax regimes is just like a different contract that is being entered into by the federal government through the NNPC and the multinational companies or the oil companies. The oil companies cannot just go over into one land and start digging or want to discover oil. They must surely enter into a contract with the federal government, and who will represent the federal government is always the NNPC. So what are the different contracts that might come up that is involved in petroleum industry? We have the first one as a joint venture contract. What do you mean by the joint venture contract? The joint venture contract, as the name implies, is just like a joint venture, joint agreement between the NNPC and the oil companies. Who represent between the federal government represented by the NNPC and the oil company is like an equity contract. It's always like an equity contract in which both parties will contribute to the amount involved in discovery, in testing, or the sum involved in involved in that petroleum activities. Under the joint venture contract, if it will be shared on the 30-70% or 40-60%, every party involved, that is the federal government and the oil company, will surely involve capital. They must surely contribute in this. Under the joint venture contract, the NNPC and the oil company will jointly contribute to the cost and share the benefits of the operation in accordance with their equity interest in the venture. The government equity contribution to the cost of operation is popularly referred to as cash call. That is, the government contribute their own money, their own part, called cash call. It's called cash call. Any contribution by the federal government through the NNPC is always referred to as cash call. But both of them, which is the federal government and the NNPC, will surely contribute to it based on the equity distribution. Class, are you with me? Joint venture agreement too. There is also a part that is it has its own tax rates. It has its own tax rate. When a joint venture agreement is entered between the federal government and the oil company, what rate will be taxed in the first 5 years and what rate will be taxed going forward? We'll look at it also. The next aspect is the production sharing contract. Production sharing contract. Under the production sharing contract between the NNPC and the oil company contractors carry out the petroleum operation in the NNPC acreage. The contractor provides the fund necessary for the operation and bears all the risk alone. Class, let's listen to this. The difference between and the joint venture is both of them, they contribute capital. If the capital will be based on 40-60%, federal government will bring 40, the oil company will bring 60. If there is a what, there is a commercial quantity involved, that is oil is being discovered in commercial quantity, both of them will surely bear the what, the reward of it based on their equity sharing. On the other hand, if oil is not discovered in commercial quantity, that is, they make a loss, they will also bear the loss. And what will be the loss of the federal government? It will be the capital he has contributed. But on the other hand, the production sharing contract, the oil company will be the one to carry out the investment, all the amounts involved from the beginning to the end until oil is discovered in commercial quantity. That is, every sum involved, every capital involved is the oil company that has to carry out every expenses. Now, how will it be rewarded for all these expenses it has carried out? The contractor bears the fund necessary for the operation and bears the risk alone. If no oil is discovered, the oil company loses. If oil is discovered in commercial quantity, the oil company will be able to recover its cost, pay royalty and tax, while the balance of the oil is shared between the NNPC and the oil company in accordance with the terms of the production sharing contract. Class, what I'm saying is that now the oil company has bear the cost involved in production, has bear the cost involved in the exploration, has bear all the costs necessary, both the capital intensive and the huge amount for what, for the QCE, up to the point in which commercial quantity is being discovered. If oil is now being discovered in this particular land in commercial quantity, the NNPC will, the oil company will be rewarded first based on oil, and this is what we call cost oil. Oil in the sense that now oil has been discovered. What is the commercial quantity discovered? What is the total cost that you've incurred? The total cost you've incurred up to the date in which the commercial quantity is discovered, oil will be taken, equivalent oil, equivalent amount of oil will be taken as a kind of what? A kind of reimbursement to reimburse the oil company. The oil company is also expected to pay royalty, both local royalty and to the federal government. Oil will also be taken, equivalent amount of oil for royalty purpose will also be taken. If it's also to pay a tax, oil will be taken as a form of equivalent amount for tax payments. Now, if there is any oil that is not being left over, it will now be shared between the what? The NNPC and the oil company based on the agreements. Hello, class, are you with me? Under this now, that is where we come about the cost oil, the tax oil, and the royalty oil. Hello, class, are you with me at all?
So, can you explain this production sharing contract?
Yes, this is what I want to hear. Because I want to know if you are with me. What I'm trying to explain under the production sharing contract. One, the oil company, they will be the one to incur every cost, starting from the discovery of the land, whether there is oil in it or not, testing the land, carry out their digging, exploration of the land until they discover oil in commercial quantity. Do you understand that, Mark? Now, if they discover oil in commercial quantity, the federal government will not bear any costs. Even though if they don't discover it in commercial quantity, definitely the loss will be their own only. Now, if they not discover in commercial quantity, they need to be reimbursed all the costs they incurred. How will their reimbursement go? The investment will be in form of oil. They have to take oil that is equivalent to amount of cost they've incurred to date. Ma, can you hear me, Ma?
Hear you. Yes.
Amount of oil they've incurred to date, the cost, the equivalent amount will be taken. They need to pay tax and they need to pay royalty. The amount of oil, equivalent amount of oil to pay for tax and to cover for royalty will also be taken. Now the balance, the remaining amount for oil, the remaining amount of the oil in that oil well or oil field will now be shared between the what? The NNPC and the oil company. The oil company part will now be in form of their profit share. That oil they take, the leftover oil that is shared between the two of them, will not be the what? The profit share or their gain in which they would sell. That is under the production sharing contract.
My microphone on.
Okay, do you understand now? Any question, class?
Yes, I understand. Thank you.
All right. The next one, the next agreement is the sole risk operator. What do we call the sole risk operator? The sole risk operator, this is applicable to indigenous operator class. Indigenous operators, they are the one that give this license, the sole risk operator license. The operator is on his own. The MMPC has neither equity or revenue interest in the operation. In other words, the operator bears the cost of the operation by itself. And when he discovers and produces oil in commercial quantity, he pays tax and royalty to the government. The oil field, the tied fund is usually the marginal field. Class, what he's trying to say now, I've already explained what we regard as what Professor as marginal field earlier on. Let me assume that this production sharing contract, the oil companies, they've already incurred expenses to a stage on a particular land or a particular field. They now discover that we cannot derive oil in commercial quantity here. After carrying out their tests, they left this field, this land, unattended to. They abandoned it. So risk operator, indigenous operators, they can be given a license to continue on that same place, on that same land. So if they discover oil, good. If they don't discover oil, good. Majorly, their one is not to discover oil in that large or commercial quantity, up to a particular quantity or barrels that can be sold on daily basis. The license is always given to what? Indigenous operators. And they strive on what? On marginal field. If they did not discover oil, or they did not even make profit, it's none of their business to the government. But when they discover oil or they make profit, they'll have to pay their tax and they have to pay their royalty to the government. So the government did not share equity in this. The government did not share oil in this. All the government wait and get from there is their tax payment and their royalty. Any question here?
That's good.
Okay, so. Okay, class. The next one. The marginal field. Marginal field is a field that has been left unattended for a period of at least 10 years by the major oil company because they believe the oil is not satisfactory in commercial quantity. The last one is the word, the risk service contract. It is also an agreement between the federal government and the oil companies, where the oil company is just an ordinary contractor class. Under this now, the oil company is just an ordinary contractor. The main feature of this fiscal regime is as follows. The contractor bears all the risk. The oil company is classified as a contractor. The federal government owns the oil concession. That license is owned by the government. The contractor has no right to the oil. The contractor has the right to purchase of oil first. The contractor is to be paid out of the proceeds of the sale of the oil. Class, why this is different from others is, under this aspect now, the risk service contract, the federal government only engage a contractor. And who is this contractor? An oil company, oil engineering company. So when they discover, they carry out all the necessary testing, every step, every activities that will make the government to discover oil in a particular field. So when they discover field, they did not own the oil, they did not share part of the oil, they did not pay tax. The government only paid them out based on the what? Based on the cost they incur today and additional marginal, their marginal gain, that is their interest, the additional profit they've added to it. They are like a contractor. Again, the other aspect is that they also have the first right to the purchase of the oil. So they've discovered oil. Because they are like a contractor, the government has paid them off based on the cost they've incurred today, plus their margins, the margins they've added to it. But they now have an additional right to oil. The first right to that oil, for the purchase of that oil, the government gives them the right. Before it can be sold to outsider or to any other person, they have the option to buy first. Hello, class. Are you all with me, class? Hello.
We're with you.
Okay, I just don't know if you are with me or not to know if it's network or please
No,
let's always.
No, we are with you.
Okay, these are the different regimes we've discussed. The joint venture contract is like an equity participation. Both the federal government and the oil company, They involve in both the cost and reward or loss, as the case may be. Under production sharing contract, only the oil company, the international companies, the oil international company bears the cost till date until commercial quantity is being discovered. Now, if the commercial quantity is discovered, they are being reimbursed based on they are being reimbursed for the cost they've incurred today using oil. Oil will be used to reimburse them. That is, they have to take oil that is equivalent to the amount of cost they've incurred today. They have to pay royalty. Oil will be taken as royalty. They have to pay tax. Oil will also be taken as tax. The balance of the oil, that is the leftover, will now be shared between them and the federal government through the NNPC. So risk operator, they are the indigenous operator. They work on marginal feed that has been left, oil land that have been left unattended to for over 10 years by the multinational companies. So their major aim is to get oil here. So this government did not involve, they only pay tax, pay royalty to the government if they make profit and if they discover oil. And the last one is the sole risk operator. Under the sole risk operator, they are like a contractor to the federal government. The federal government only contract them to work on a particular land and discover oil there. When they discover oil, the government will pay them their cost incurred today plus their margin they've added to it. The only hard thing now is that they have the right, they have the first try for the purchase of the oil, before the government sells the oil out to an outsider. Class, any question here, please?
Sorry, please. So under production sharing contract, it means that they make the transactions based on cost, based on oil rather, and not any form of payment. They pay in form of oil, right?
There is always in form of oil. They are reimbursed the cost. They are reimbursed the cost, their cost, their royalty, their tax, all in oil.
Okay. So oil is like their currency. Okay, thank you.
What's it?
So oil is like their currency, like what they use for
Yes,
the.
they pay in oil. They've already incurred their cost. So now that we've discovered oil here, so the equivalent amount of cost have incurred. Instead of the federal government to pay them out, the government will take the amount of oil that is equivalent to this cost. You have to pay tax, take the amount of oil that is equivalent to the tax. You understand? You have to pay this, you have to pay royalty, pay the amount that is equivalent to royalty. And then the balance will now be shared between the federal government and them for sales.
All right, thank you.
All right. So class, after this, now we are moving. After this, now we need to look at the tax computation for petroleum company. The tax computation for petroleum company. And before I move to the tax computation for petroleum company, I want us to understand this very well. One, petroleum company, they have different major source of income. They can derive their income from the sale of gas, and there is a computation for it. They can derive their income from the sale of chargeable oil, and there is a computation for it. They can derive their income from disposal of chargeable oil disposed. There is a computation for it. Miscellaneous income also. After this income has been known and has been gotten, the next thing for me to do is what? To deduct my allowable expenses, as the case of the company income tax. Class, listen to this, is to deduct my allowable expenses as the case of company income tax. Part of my allowable expenses, we are going to look at it. There is one aspect called educational tax. Educational tax. We all know that our educational tax is always 2% of accessible profits. Hello? Who is this? Mute your mic. Mute your mic. Education tax is a 2% of our accessible profit. So for a company income tax, education tax is not part of its allowable expenses. But for a petroleum company income, for a petroleum operation or petroleum profit tax, the 2% of accessible profit, it is an allowable expenses. For me to get my adjusted profit, I must have add back these allowable expenses. For me to get my adjusted profit, I must have add my balancing charge. You know what I mean by balancing charge? If there is a sale of what QCE during the year and I make a profit on it, and to add that profit, it is a taxable income. Now, part of the allowable expenses for petroleum operation is the education tax. And this education tax is 2% of accessible profit. And before I can get my accessible profit, I must have deducted all my allowable expenses. I must have deducted my loss relief for that particular year. Hello? Class, are you with me?
Yes, sir.
Now,
Yes.
the question is that I did not know my accessible profit. but I need to get 2% of my assessable profit as 2% of my assessable profit as education tax, which is an allowable expenses. So the question is, for me to get there, I will do 2%, 2% means 2 over 100. I have to do what? I have to gross back, that is 2 over 102 of the assessable profit before deducting the education tax. Hello, class. I have to do 2 over 102 of the what? Of the assessable profit before deducting education tax, and that will give me my education tax, which I will now allow, add it to my other allowable expenses, deduct my loss relief to get my original assessable profits. Again, we'll be looking at other aspects of the allowable expenses. So what are these allowable expenses under petroleum profit tax? Class, let's quickly look on to it. Class, allowable expenses under petroleum profit tax. 1. Class, we need to take note of this. Who is this, please? Mr. Eze, mute your mic, please. Allowable deductions, which are allowable expenses under petroleum profit tax. The first one will be looking at what? Any rent of accommodation for a member of staff, provided that it does not exceed more than 100% of the base salary of the staff. In a nutshell, rent of accommodation to staff, it is an allowable expense. This provision is provided that it is not more than 100% of the basic salary. Class, except we demand for the what? The salary schedule. That is when we can know whether it is the 100% or not 100%. Majorly, if you see it in the example, if there is no any additional information regarding the rent of accommodation to staff, please allow it. Class, are you with me? 2, bad debt written off. We all know that bad debt is also an allowable expenses, both in SITA and petroleum profit tax. Bad debt written off is allowable. Provision for bad debt of specific nature. Class, in a nutshell, all provisions should be disallowed, both in company income tax and petroleum profit tax. Only provision for bad debt of specific nature. If I'm making a provision for debentures, if I'm making a provision for dividend payment, all these that should be disallowed. The only provision that will be allowed is provision for doubtful debt of specific nature. Class, what do you mean by this specific? That it can be traceable to a particular customer or to a particular invoice immediately. Provision for bad debt of general nature, class, you disallow it. Now, education tax, with effect from 1986 tax year, it is an allowable expenses. This is what I just explained. Education tax is an allowable expense, and it is always 2% of assessable profits. Before I derive my assessable profit, I must get my education tax. How will I go about this? I have to find the assessable profit before education tax. Apply 2 over 102 of it. That will be your education tax. Go back to your working. Add that amount as an allowable expense, which is the education tax. Then deduct your loss. Then you get your original assessable profit. Intangible dealing costs. What do you mean by this intangible dealing costs? That what? Costs that involve what? Maybe testing, discovery, or searching for what? For oil. You are doing research on oil, you are testing the oil, you are trying to discover what is that intangible, or let me say they are relevant, but not that much. Intangible drilling costs. But any costs that have to do with tangible drilling costs, these are to be qualified under QC, qualifying capital expenditure, and it is to qualify for what? Capital allowance under the petroleum profit tax. And intangible drilling costs, as it as an expenses, it is allowable. Royalties, if they make a royalty either to the federal government or to the local or any export sales, it is an allowable expenses. Under the production sharing cost, we are saying that they have to pay royalty, and the royalty will be taken in form of oil. Why do they have to be reimbursed them back in form of oil? Because the royalty they pay will surely be in form of it is an allowable expenses. The royalty they pay is an allowable expenses. That means they will be reimbursed them back using oil. Productive and not productive rent. If you see in a question, you have rent, productive, you have rent, not productive, plus allow it is an allowable expenses. Custom duties on essential and non-essential items. Custom duty on essential and non-essential items, class, it is an allowable expenses. Only provided that custom duty you paid, you can derive that same item you imported. Before you can pay custom duty, you must have imported an item, either an item for QCE or plant or any it is. And you can derive that same item that same item, the same quality, the same quantity in our local market here, we now decided to import. And we expect the government to waive the custom duty. No. The custom duty on essential and non-essential item will only be allowed if we cannot derive or we cannot get the same value or the same quantity or the same quality of that same item in our local market in Nigeria. Hello, any form of liability for which was incurred by the company by way of duty, including stamp duty, custom duty, excise duty, and acquisition duty to any federal, state, or local government other than tax imposed by federal petroleum education tax. What he's saying is that the petroleum company are not expected to pay any other tax rather than except only the petroleum profit tax. Legal expenses class. The same legal expenses that is allowable under SITA is also allowable under the petroleum profit tax. What are the legal expenses that is allowable under SITA and is also allowable under the company petroleum profit tax? We'll be looking at legal expenses for advisory service, your retainership fee for your lawyers, retainership fee for your accountant or your advisors. They are what? They are liable. Renewal of short-term lease is allowable. Retainership fee, cost of protecting and defending the business. Cost of protecting and defending the business class, it is an allowable expenses. But when it comes to legal expenses incurred for acquisition of lease, whether it is a short-term lease or a long-term lease, class, it is a disallowable expense. You disallow it. Legal expenses incurred for acquisition of lease. Legal expenses for renewal of long-term lease disallowed. Legal expenses for renewal of long-term lease disallowed. But legal expenses for renewal of short-term lease, please allow it. Legal expenses for acquisition of lease, either short or long-term, disallow it. Any other expenses which are wholly necessary, exclusively incurred for petroleum business. Royalty on natural gas sold. Royalty, any royalty you are paying, please, you allowed. Repairs and maintenance, premises, plant and machinery or features, they are all allowable expenses. Class, are you with me at all? Hello, class.
So, commenting on the meaning of WR.
These are expenses incurred wholly, reasonably, exclusively, and necessarily. Hello, ma.
EN.
Okay. Please, you all understand these allowable and the allowable expenses now. Class, okay, let's quickly have a brief computation for that education tax, because education tax is very important under petroleum profit tax. You can get your full answer if you compute it well. And at the same time, you can get it wrong if you don't compute it well. As I've already said, I say my education tax is a what? Is an allowable expense, and it is 2% of what? Accessible profit. It is 2% of accessible profit. How will I get my accessible profit? Class, let's go through one. Let's use the board. I'm looking at it. Let me assume that I have my net profit as per account, or I'm starting from the income aspect directly. I have an income that has to do with what? Local sales. I have an income that has to, local sales and export sales as well. I have the value. I have this value. I have my balancing charge because it is taxable, a particular amount, and it gives me the total income. Class, what is the next thing I need to do? I need to less my allowable expenses. Allowable expenses. Class, do you know why I'm lessing my allowable expenses? Because I'm starting from the computation from the income directly. On the other hand, if I'm starting from the net profit as per account, I have to add back disallowable expenses. Hello? I'm not sure you have. Can you hear me at all? Hello, class.
We meet other. We can hear you.
You can hear me, and you understand what I'm explaining.
Yeah.
Do you understand what I'm explaining?
Yeah.
Okay. Part of the allowable expenses, as I said, we mention royalty, right? We mention intangible drilling costs. There's something that I don't know whether I added it to it. first two appraisal cost for drilling of the first two appraisal wells. The first two appraisal wells also an allowable expenses. The cost of drilling for the first two appraisal well is also an allowable expenses. Though I will get there, it seems I have not completed all the allowable expenses. So class, what I need to do here is that education tax is also an allowable expenses. And this education tax, it is what? 2% of my assessable profit. How will I get my assessable profit? After I've added all my allowable expenses, I'm to deduct, let me assume that I've got a value, and this value is my adjusted profit also. I'm to deduct loss for the year. If I deduct the loss, the amount I derive out here is my what? Is my assessable profit. I'm expected to put 2% on this, 2% of assessable profit as my education tax. And before I can get my assessable profit, I must have deducted this education tax, which is an allowable expenses. So the question is, how will I know my education tax, which is 2% of assessable profit, whereas I have not even deducted the education tax, I don't know the original assessable profit. That's how will I go about this? If I see this in the example, what I need to do is that I need to get my assessable profit before deducting the education tax. That is, what is the total allowable expenses before education tax deduction? I will get the value, deduct my loss from it. The amount I get, which is the assessable profit, I have to apply 2/102. It's like I'm grossing back 2/102 of it. It will give me the education tax. Then I go back to my question, education tax inputs. Class. Hello, class. Okay. Okay. What I'm explaining is I've already gotten all my income. Let me say the total income is 2 million or so. Allowable expenses. Addition of royalty, intangible drilling costs, every other legal and the likes, the allowable legal, everything. Let me assume that the total of this is what? 500,000. What is the next thing I need to deduct? I need to deduct my education tax. Education tax is what? 2/100 of assessable profit. But I don't know my assessable profit now. Let me ask, my education tax will be question mark. I don't know. What is the total?
It's 600 meters. At the roundabout, take the third exit.
Hello? Class, are you with me? Are you getting me? Hello?
Continue.
Okay. If I deduct this 500,000 from the 2 from this, how much do I have? 1.5. This 500, this 1.5 is before deducting the education tax, you know. Yes. Then if there is a loss relief, the loss I have to relieve for that particular year. Let me assume the loss is 500,000 too. How much do I have? I'll be left with a balance of 1 million, right? This 1 million is what? Assessable profit. But this assessable profit is what? The assessable profit before deducting education tax.
Okay.
Are you with me, class? The assessable profit before deducting the education tax. Now I need to get my education tax. For me to get the education tax, I will apply 2/102 of this value of the assessable profit before education tax. So it will be 2/102 times 1 million. That will be my education tax.
Why is it 2/102 and not 2/100?
The reason why I'm applying 2/102 is before I can derive my assessable profit, I must have deducted education tax. But I haven't deducted the education tax. I derive assessable profit. I have to gross back. It's called gross back. So for me to gross back, we apply 2/102. Class, if I apply the 2/102, after deducting my education tax, I apply. If I have now applied 2/100 of it, I will derive the same answer. What is 2/102 of 1 million, please? Please, I'm waiting time, please.
19,607.8.
607.8, right?
Yeah, yes.
Okay. Adding to 500,000. So I'll be having what? I'll be having. Hello, ma. Are you with me, ma? I want to do the working so we can just get it. So if I add it to 500,000, what will be my total expenses? 519,607.8. Deduct it from the 2 million. What do I have, class?
1480.
One word.
1480.
392.
Okay, call. Keywords. Please, let's be fast. Time. This is we must
1480.
1480. 392. Class, this is a loss relief which I have to deduct. So the loss of 500,000, remove it from it. And what did I have, class?
$980.
5 words.
980.
980 words.
392.
980, 392. Let's see. 980, 392. 980, 392. Class, you know that this 980, 392 is the assessable profit after deducting education tax. Class, if you find 2 over 102, 2 over 100 of this 980, 392, it should give you the same 19,607. Please find 2 over 100 of it. 2% of it. Do you give what is what?
19,607.8.
607.8. Class, this is one of the area that gets us confused when we are in the example. One is either we forgot. Hello, class. Are you with me? This is one of, hello, please. One class, please. What I'm saying is that this is one of the areas that make us fail petroleum profit tax. One is either we've already forgotten to deduct education tax, or instead of applying 2 over 102, we apply 2 over 100. And meaning that if you've gotten one wrong, you cannot get the right answer. Just imagine they ask me to get accessible profit.
In 100 meters at the roundabout, continue
Who is
straight.
this, please? Mute yourself. Don't make up. Others are in the class. Hello, class. Are you with me, class? Hello.
Yes,
Hello, sir.
Yes.
The noise is much. People should try and abide with the rules of the class, please. And let's listen to this topic because it's very, very important to us. Please.
Great class. What I'm saying in essence is that when it comes to petroleum profit tax, education tax deduction is one of the areas that will make us to fail that question. Areas in the sense that is either we fail to deduct the education tax before deriving my assessable profit. 2, if I even remember to deduct the education tax, so we apply 2 over 100, whereas I should have applied 2 over 102 to get it first.
Excuse me, let Christian and
Admin, please mute everybody.
Mute everybody, sir.
Admin, please mute everybody, please. The noise is too much.
Everybody be muted as well.
Okay. So what I'm saying here is that, so this education tax area, let's take it in serious and very important, is simple. One, either I'm using the income area or I'm using the net profit as per account. I need to deduct education tax. It is an allowable expenses. This education tax is 2% of my assessable profit. I don't know my assessable profit except I deduct education tax. What will I do? Get the assessable profit before deducting education tax. That is, get everything. Deduct your loss from your adjusted profit. If there is a balancing charge, add it to the income already. Then get your assessable profit. After I've gotten my assessable profit before deducting education tax, apply 2 over 102 of it. 2 over 102 on that assessable profit before deducting education tax. That will give you education tax. Then go back to your work. You can do that as a walking. It should always be a walking. So go like walking number 2 or 3 down. Education tax computation. Total income as per account 2 million. Allowable expenses before education tax 500,000. loss to be deducted, that the loss relief to be deducted 500,000. Assessable profit before education tax 1 million. Education tax 2/102 of that 1 million. Then go back to your original working. Put your education tax there because it's an allowable expenses. Then continue your workings. Class, is this clear?
Yes, sir.
Very.
Sir,
Okay, I'm with you.
I don't know. We are having two assessable profit now.
Yes, we have the assessable profit before deducting education tax, which is the fake assessable profit. You only need it for you to get your education tax.
Okay, okay.
Are you with me? Is that assessable profit that applied 2/102 on? The original assessable profit, now that I've applied 2/102 and I've gotten my education tax, I have to come back. Now, okay, let me use this way. That assessable profit before deducted education tax should be a workings, should be part of your workings. Your question might not ask you to compute education tax. And you know that for you to continue your work, you must deduct education tax. So you need to do a workings for it. Working number 1, all income, total income, 2 million. Allowable expenses before education tax, 500,000. Loss, 500,000. Assessable profit before education tax, 1 million. Education tax, 2/102 of it. It is a workings. That one is a working. I've gotten my education tax. I need to go back to my original computation of what? Petroleum profit tax. Where I've deducted every allowable expenses. Then I need to put education tax that I've gotten from that working, deduct it, then continue your working and get your original assessable profit. Any question, please? Class, any question, please?
So please, if I may understand clearly, we're
Okay,
supposed to deduct loss before computing deduction tax in our workings.
Before getting education tax, before
sir.
you can derive your assessable profit, you must have deducted the loss.
Okay, sir. Okay, sir.
You must
Yes,
have
sir.
deducted loss before you can get assessable profit. And education tax is 2% of that assessable profit.
Okay, sir. Thank you, sir.
Right. So class, back to the working. Look at this education tax computation. With effect from 1966 tax year, this has been allowed as an allowable expenses. It is pertinent to note that education tax itself is not an expenses to be generally or normally included in the profit or loss account of any petroleum operation company. It must, however, be determined before determining the tax liability of the company. Education tax allowed equals to net profit as per account. Class, if I'm starting from the net profit as per the account, add back non-allowable expenses. Class, NA, it means add back non-allowable expense or taxable income not included before. As an accountant, I do what? I understate my receipt, my income, just because I want to have a lower tax liability. The federal government, during their tax audit or tax registration, they now discover this. They will add back this income, this receipts. You understand what I'm saying? As an accountant, there are some expenses like provision for doubtful debt of general nature. I've already allowed it as an expenses. During tax audit or tax investigation or debt review, they add it back to it. You understand? So minus allowable expenses. There are some hello?
Please.
Minus allowable expenses. What is this allowable expenses? Expenses the accountant failed to recognize or he omitted. I omitted some expenses when computing my tax liability. But these expenses are allowable. I have to minus it. Or non-taxable income included before. There's some income the accountant has included for him to derive his total income, and this income are not taxable. Income like what? Either loss or profit, either profit or what? Disposal of fixed assets. Profit made on your foreign currency exchange. Class, are you with me? All these, they know they are an additional income to you, but they are not taxable. Then add your balancing charge, deduct your loss. This will give you your assessable profit before education tax. Then apply 2/102 on it. It will give you your education tax. In summary, whatever is arrived at education tax must be 2% of assessable profit. So after deducting your education tax, You now derive your original assessable profit. If you still apply 2%, not 2/102 this time around, you will derive the same answer. Illustration 1. Net profit as per account, 320,000. Disallowable expenses, 89,000. Am I adding or subtracting from the 320,000? Disallowable expense of 89,000.
You add back.
I'm adding back. Other
Yes, sir.
taxable income. Other taxable income, 43,000. Add or minus?
Deduct.
Class, I'm asking. Someone said deduct. You
You are not
back.
including.
You had back.
You add
No,
No, you
back,
are
sir.
not including
You
it.
had it back.
I'm not including it. Class, these are the things we need to understand before getting to the example. Why am I adding back? Hello? Class,
Yes,
please
sir.
talk. Why am I adding back the 43,000? Or why am I deducting? Or why should I, even though ignore or not inputting it at all, other taxable income?
Because
No, it's part of the income that should be taxed. So
Part of the income that should be taxed. Why? The accountant has already maybe understated his income. I have some receipts. I want to do my tax planning, or I want to evade tax. And now I now understate my income. If I understate my income, I'll be having a lower income. And at the same time, I'll be paying a lower amount as tax. So the paying tax audit, tax investigation, or debt review, they discover this. This will be added back. It is taxable. Other taxable income, add. Allowable expenses, will I add or minus?
Minus.
Minus.
Non-taxable income, will I minus or deduct? Will I minus or add?
Minus.
Give me an
Minus.
example of this non-taxable income. Give
Minus.
me one example of non-taxable income.
Non-taxable income.
One example of non-taxable income.
Capital gain
From
tax.
sales of fixed asset.
What?
Profit from sales of fixed asset.
Fixed asset. Yes, it is not taxable. Someone say capital gain tax. That is also, do you know the reason why the profit from sale of fixed asset is not taxable? Because it will be subjected to capital gain tax. You understand? It will be subjected to capital gain tax. If I'm taxing it under SITA or petroleum profit, that means I'm double charging that company. You cannot expect me to pay capital gain tax on this, and at the same time, you expect me to pay company income tax or petroleum profit tax on this again. No. Foreign currency gain or foreign exchange gain. For your foreign exchange gain, is it taxable?
Yes.
Foreign exchange gain,
You add it back.
I have to add back. It is not taxable. Foreign exchange gain, your currency, you buy goods from South Africa at the sum of 5,000 quantity for 350. Now in 2000, after 3 or 4 years, you now want to pay back. Instead of the exchange rate has reduced, you are now making a gain. This gain now, it is part of your what? Appropriation income. Is an income to you. Class, this is not taxable. It is a non-taxable income. Loss brought forward 121,000. Balancing charge 13,000. Am I adding or subtracting? I have to add it back.
Add back.
Compute the education tax. Compute the accessible profit. Class, should we quickly do this, or I should assume we know it? Then move on.
let's do it.
Because I'm also looking at the time.
Let's move on.
Let's move on. Others, do you all agree we should move on?
Let's move on. When we get to the one that will require details computation, we will do that together.
Okay. Okay, class. Non-allowable expenses continue. Non-allowable expenses. It is one. Depreciation of assets. It is a non-allowable expenses. Tangible drilling costs. It is a non-allowable expenses. Are you with me, class? Any capital expenditure, either refurbishment, overhauling, these are capital expenditure. They should be enjoyed capital allowance and should not be passed as an expense. It is a non-allowable expense. Any cause of obtaining information as to the existence of petroleum deposits, it is a non-allowable expenses. This should be regarded under it should be a part of the tangible dealing costs. Yes, it's part of the tangible dealing costs. The tangible costs include the obtaining of information as to the existence and the extent of petroleum deposit. Any sum recoverable under contract of indemnity or insurance have already insured a particular indemnity or a particular risk. It now occurs. Insurance company now pays me. Class, this should be a non-allowable expenses. Their loss are incurred or the risk at the occurrence of the risk, I should not pass it as an expenses. Contribution to pension, provident society, savings and widow scheme for not approved by joint tax board. Any contribution to all these schemes that is not approved by joint tax board, it is a non-allowable expenses. Income tax provision and other tax provision, any tax provision that is not, it should be a word, non-allowable expenses. Fines and penalties. Fines and penalty, either default, traffic offense, fines relating to late payment or late filing. There should be a non-allowable donation. Class, under PPTA, petroleum profit tax, there is nothing like donation. Under CITA, there is a donation, but it has a clause to it. You understand? It has a clause. It must not be more than a particular, it must not be more than 10% of the what? Of the profit, of the company's profit before deducting the donation itself. Under petroleum profit tax, nothing like donation, it is disallowed. Preliminary or pre-operational expenses. Any cost that relates to preliminary or pre-operational expenses, disallowed. Legal expenses such as, I've explained this earlier on, renewal of long-term lease, acquisition of lease, either short or long-term. Cost of defending tax appeal and traffic offense should be disallowed. Loss on sale of fixed asset, please disallow it. Capital withdrawn or repaid or appropriation out of profit, you are the owner of the company. You now decide to withdraw some of your capital. That passes as an expenses. Instead of it to reduce your shareholding capacity, no, disallowed. Custom duty for goods imported for resale or personal consumption. I import goods for resale or for personal consumption. Not custom duty on tangible or intangible costs, intangible expenses, intangible items in which will be used for company operation. This one it will be what? For resale. I want to buy to resell. Am I into buying? Am I into a trading company? Am I buying and selling? No. If I'm into buying and selling, definitely I should be looking at under CITA also. This is a petroleum company. Any custom duty for goods imported for resale or personal consumption, disallowed. Rent or repairs, premises not relating to petroleum operation, please, disallowed too. So we've explained the fiscal regime. So let's look at non-taxable income according to PPTA. The following are not subjected to tax. Profit on disposal of fixed asset, I've explained this. Any reversal into income of previously disallowed income. Class, what he's trying to say, I have some year as at last year or last 2 years, I've already passed some item as a what? As a non-taxable income. Let me say, or previously disallowed expenses. Let me say previously disallowed expenses is now being reversed into income in the sense that, let me use a provision for doubtful debt. Class, are you with me, class? Provision for doubtful debt, general nature. Provision for doubtful debt, general nature. Last year, I passed as an expenses. The tax official, they disallow it. I pay tax on it. This year or in the next 2 years, the person that later paid. Class, are you with me? The person that later paid, you know, is an income to me. Will the government not take tax on it? No. Hello, class, you understand this? No. Hello? Class, are you
No, I don't understand. Oh, I don't understand.
Don't understand. What I'm saying is that a reversal into income of previously disallowed, it should be disallowed expenses and not income. Or previously disallowed income or expenses the same. What I'm saying is that I have some expenses last year. This, as an accountant, I've already passed as an expenses. Let me say a provision, a particular provision, either provision for bad debts, general nature, or provision for bad debts. You know, it is a disallowable expenses. Me, I pass as an expenses. The tax officials, they now disallow it. I pay tax on it last year. This year now, the person now make that payment. You understand? The person now make that payment. And this payment is an income to me now. Yes. We tax official now tax me on that income. No. It is a reversal into income. a reversal into income of previously disallowed expenses stroke in contributing previously disallowed expenses. Income from transportation of ocean-going tankers. This is not income to be subjected under PPTA. Remember, when we are discussing upstream and downstream sector, but to be subjected under SITA, any expenses will be disallowed under PPTA, but will be allowed under SITA. What is saying is that any income that you as a company, I'm into petroleum operation, I should be taxed on PPTA. And I involved in other activities that involve transportation of my petroleum my petroleum products to the final users. Are you with me? And I make an income from it. Because that income should not be subjected to PPTA, but should be subjected to SITA. The same thing applies to any expenses that applies to that income. That any expenses I incur that relates to me making the income from this transportation should be allowable under company income tax, but disallowed under petroleum profit tax. Now, is this clear?
Yes, sir, but I have a question.
What is the question, please?
Okay, so a company involved in petroleum operation, does it mean if such company is also involved in other line of petroleum business that will be necessarily be subjected to company income tax? So that means the company will be preparing two accounts.
The same question, exactly. Expect such question in the example where you will prepare for SITA and prepare for what? Petroleum profit tax. That is what it means. Yes.
Okay.
Income from refinery operation. This is to be subjected to SITA like that of the ocean-going tankers. Refinery operation, that is refining the product, not extracting the crude oil. When it comes to refinery of that petroleum operation, they are to be subjected on their company, they should pay tax to company income tax, and they should not pay petroleum profit tax. Basis of assessment of petroleum profit tax, class. All petroleum profit tax should be assessed on AYB, actual year basis. Hello, class, are you with me? To be assessed to actual year basis, not preceding year basis as the case of company income tax. If I'm assessing for 2002, my accounting year will end as at the 1st of December 2002, and the profit I will pay will be for that same 2002, not for 2001, as the case of company income tax. If I commence in the month of June, my tax will be from the month of June to the 1st of December of 2002. Are you with me, class? And I will pay tax. My year of assessment will be 2002, and I will pay tax based on the income I made from June to December 2002. If the company is already an existing company, for every year of assessment, it will be from 1st of January to 31st of December of that same year. If the company is ceasing operation, it will be from 1st of January of that year to the date of cessation of that same year. I ceased in 2002. I ceased in the month of March 2002. My tax liability will be for the same year of assessment, 2002, basis period from 1st of January 2002 to March 2002. AYB. No preceding year basis under the petroleum profit tax. Class, is this clear? Hello, please, let's talk, please.
Yes.
Okay, we move on. Petroleum profit tax computation format.
Sorry,
okay, I'm with you.
Generally, for under the company income tax, we have commencement rule that is applicable. So if a question comes under PPT and it relates to a company that is just starting operation, so what is the commencement rule in PPT?
PPT from date of commencement to 31st of December of that same year of assessment that same year.
Okay, nothing more than that.
Nothing more than that.
Okay. All right.
Petroleum profit tax computation format. Value of chargeable oil sold or value of chargeable oil disposed. Value of natural gas sold. All these are the income. Other incidental income of petroleum operation. Profit of the accounting profit. These will give me the total income or total income. It will be total income of the accounting profit. Less allowable deduction. Then I'll get my adjusted profits for the accounting period. Deduct loss, unrelieved loss brought forward. Then I have my assessable profit. Then I will compute my capital allowance computation. Capital allowance computation Capital allowance for petroleum profit tax will include annual allowance, nothing like initial allowance under petroleum profit tax. Capital allowance family will include annual allowance, unrelieved capital allowance brought forward, petroleum investment allowance, and balancing allowance. 4. Class, annual allowance, unrelieved capital allowance brought forward, petroleum investment allowance, and the word balancing allowance. Class, you all know what we mean by balancing allowance. When there is a word loss on disposal of what QCE, you compare the word, the sales proceed and the tax written down value. Class, are you with me at all? You are not making a loss. It is an allowance to be added to the capital allowance family. Now, I know the total capital allowance that is what? That is chargeable during this year. After adding all this, and we compare it with class restriction. There is a restriction on the amount to be deducted or the amount to be actually be charged against the assessable profit as capital allowance for the year. 1, I will compare with 85% of my assessable profit. I will now less 170% of petroleum investment allowance from it. The lower of it will be the amount of the capital allowance I will actually charge during this year. The question now is, how do we compute petroleum investment allowance? And how do we compute the annual allowance? Hello, class, are you with me at all?
Yes, yes, yeah.
Very clear, right?
Sir, can you come again?
The various explain.
Can you take it over again?
What I'm saying is, for me, for the format for computation of petroleum profit tax, the total income, and the total income will come from 4 major operations. 1, value of chargeable oils sold, value of chargeable oil disposed, value of natural gas sold, and miscellaneous income, 4 income. Each of them has the way we are computing them, and we get there. After I've added all these 4 income, then I less my allowable expenses from it. It will give me my adjusted profit. For my adjusted profit, I deduct unrelieved loss brought forward. Loss of petroleum profit is always carried forward indefinitely. Indefinitely. Unrelieved loss brought forward, I will deduct. It gives me my assessable profit. If you go back to our education tax, you know, for me to get my education tax is 2% of this assessable profit. Because I don't know the education tax, that is why I'm using 2/102 of the assessable profit before deducting the education tax. Now, after I've gotten my assessable profit, the next thing I need to do is deduct capital allowance. And for me to deduct capital allowance, there are things I need to take note of. What are these things? 1, what is the capital allowance family for that year? That is the total capital allowance I'm entitled to during this particular year. And it comprises of 1, annual allowance plus petroleum investment allowance plus balancing allowance plus capital allowance brought forward, that is unrelieved capital allowance brought forward in the previous year, that is carried forward to this next year. The total, I will add it. Let me assume that it is 200,000. I will compare it with 85% of assessable profit. What is my 85% of the assessable profit I've gotten? 150,000 less 170% of petroleum investment allowance from the 85% of the assessable profit. If you give me a value, that will be the B. Then I'll compare it. Class, let me do it this way. Let me use the board so you understand better. I want to find capital allowance for the year. There is a restriction. Restriction on capital allowance is the lower of A. What is this A? A comprises of 1, annual allowance. B, petroleum investment allowance. C, unrelieved capital allowance brought forward. And 4, balancing allowance. I will compare this A, the total of this. What is the total? It gives me a particular total. I will compare it with B, which is what? 85% of my assessable profits, less 170% of petroleum investment allowance from it. Let me assume this. It will give me a particular value. I will compare these two the difference between A and B, the lower of it will be the actual capital allowance that is claimable, that I can claim during that particular year. Hello, are you with me, class? Now, the question is, the difference between, if this one is greater than this, definitely I'll be using this. The difference between this, that A and B, will become unrelieved capital allowance that will be carried forward to the next year. Class, any question, please?
Noted, sir.
Noted. Others, please. Is it also noted? Madam?
Yes, sir.
Noted. So we can move on, right?
Yes, sir.
Go ahead.
Okay. So we need to. Okay, class. If this is noted, then the next way is assessable profit tax, chargeable to tax. So now I have to find the assessable profits. Assessable profits actually has always been 85% of chargeable profits. My chargeable profit. My chargeable profit is the amount I derive here after deducting the capital allowance. Then I'll get my chargeable profit. Assessable profit is 85% of chargeable profits, provided that. Now the question is, class, in the example, we might be given a question that we have to base on different tax regime. Are you with me, class? We might be given a question that will based on different tax regimes. Let me say that they can say that Deep Sea Limited is into a joint venture agreement with the federal government. Hello, class, are you with me? Is into a joint venture agreement with the federal government. Definitely, I know that this petroleum profit tax, the tax you'll be paying, will be based on the rate that is applicable to joint venture agreements.
Okay.
Hello, are you with me, sir? Again, you might be given a question that have to do with a word. Deep Sea Nigeria Limited is into a word, a production sharing contract, NMPC, and he has the following accounting year. He has the following accounting transaction during the period 2002 or 2003. What will happen here is I have to apply the rate that is applicable to production sharing contracts. Now, what are these rates? Class, let's know this. In any question, identify the fiscal regime being tested.
Okay.
So, for a joint venture company, assessment will be at class. Listen to this. For a joint venture company, that if it is a joint venture agreement, the assessment will be 65.75% for the first 5 years. Assessment will be at the rate of 85% for the 6th year forward. That is, if the company is still in its first 5 years of existence, apply 67.75% of the chargeable profit, and that will be the amount of its tax liability. But if the company is already an existing company, class, I'm applying 85%.
So apparently, the question is testing 2 periods, like requiring us to compute for 2 periods, one being the 5th year and the second being the 6th year. So for the 5th year, that means we're going to apply 65.75%, while the 6th year, we're going to apply 85%, right?
Yes, if the question is that but majorly petroleum profit tax, they are testing for 1 year. They will give, it's on AYB. You are paying tax and you are computing tax computation for a particular year. What will come to my head is it an existing company? For how long has it been in existence? Look at the question. Is it relating to, if it says that the question says that the company started operation in 2004, and this account relates to 2006 year of assessment, and is a joint venture agreement with NMPC. Now he's still in his first 5 years of operation. Definitely I'll be charging was 65.75%. But if the company has already been existing, and the question says the company has been existing for a very long period of time and is in a joint venture agreement, what rate am I charging? 85%. Class, is this clear? Again, MOU credit is applicable. What is MOU credit? MOU credit, we would look at it, how it is being computed. It's like a what? A tax credit. It's like a relief. I'm paying, imagine look at this amount, 85% on my chargeable profit is going to the government. I should have some kind of relief to offset or to reduce, just like a withholding tax. You know, withholding tax can be used to reduce your tax liability. Hello, class. Are you all with me at all?
Yes, sir. We're here.
Yes. So the same thing, MOU credit. If there is MOU credit, under the MOU credit, we will look at the computation. Because petroleum profit tax is wide. I'm looking at this week and next week, if it will even be enough. We've not even started the question, the income aspect at all. So MOU credit, we're looking at how it is being computed. We'll be looking at the initial government take, the revised government take. What do you mean by the initial government? Is everything has to be based on oil. So the government, all these 85%, they are reimbursable in oil. Majorly, you cannot expect to be looking for money. The NNPs will only take part of the oil I've discovered in commercial quantity, and that will offset my tax liability. If the government have already taken an initial oil take, there should be a revised oil take. There is a way everything is being calculated. So we surely get there. And this will be used as a tax credit to reduce my tax payment. My 85% have computed. So they say that MOU credit is applicable as tax offsets, no investment tax allowance under joint venture company tax regime or agreement with the NNPC. Are you all with me at all? Next one, if a production sharing contract is being tested, investment tax is applicable. One, rate is 85% on QC, no MOU credit. Assessment will be 50% of chargeable profit. What he's saying is that if production sharing contract is tested, it is 50% will be chargeable. Majorly, the question I've always been seeing is a joint venture agreement or not stated, then I'm applying 85%. If the question is silent on the tax regime, please apply 85%. But if the question says that it is a production sharing contract, apply 50%. Hello?
Okay.
Say, for risk service and sole operator, class, you still remember the regime under the risk service operator and sole operator. The risk service operator are the ones that are the indigenous that work on marginal field. The sole risk contract are the ones that have to be like a contractor. Government will only engage them to discover oil here. All the concession and the ownership of that oil is in the hands of the government, is left to the government. Government will only pay them off based on what? Based on the agreement and the cost they incur today, plus their margins they have there to it. And they also have the first right towards taking of petroleum and selling petroleum to them, the crude oil to them before the government can sell to any other party. So the rate is also applicable under the joint venture, 65.75% based on the 5 years, first 5 years, and going forward, 85% will be tested. Under this, no investment credit allowance, no MOU. How we compute investment tax credit allowance, we also look at it. Class, any question, please, before we move on?
Let's move on.
Let's move on. We've not even started that. So you can see the reason why I was looking at, maybe we should just do the, you can see we've covered major all the theoretical aspects and it's good. So class, that is what we just need to understand. Then we look at the different income like this. Let's work on two types of income today. So we can just move on next week. Taxable income, other petroleum income tax. Taxable income. You know, I said that for me to know my assessable profit, I must know the income. I must have gotten the income. So the income is derived from 4 major aspects. One, as a petroleum company, I can derive my income from one, value of chargeable oil sold. How? This is what I have to do with posted price, adjusted posted price that we need to calculate. Plus, petroleum profit can come in any areas and is simple and straightforward if we understand the principle applicable. Hello, class, are you with me? Very simple.
Yes, sir.
And straightforward. Tax in general, I don't see the reason why we should pay tax if we understand what we want to do. The only thing that will make us to fail tax is when we get confused in the example. Maybe we become rejecting capital allowance, we call capital allowance computation, or we fail to compute one. You know, when you fail one, you fail others. Just imagine I did not get my adjusted profit well, then my assessed profit will be wrong, my chargeable profit will be wrong, my tax liability will be wrong. If I don't complete my capital allowance well, the same thing we apply. That is the reason. But if we do it well, and please, let's lay hands on past question. We should start work. Don't assume we know it. That is one of the reasons why we fail taxation. Let us not assume we know it. You might know it. Please work it. Do workings. Solve something. What you know, redo it again. Class, are you with me, class? So, class, back to the income. I said the income is derived from four major areas. One, we can get from the value of chargeable oil sold, value of chargeable oil disposed, value of natural gas sold, and miscellaneous income or incidental income. Class, let's start from the value of chargeable oil sold. Value of chargeable oil sold. Value of chargeable oil sold. Class, this is very, very examinable. You will see a question in which you might just be lucky that we can be given the local sales and export sales. We have known my total income. Let me assume that I don't even know the sales. I'm not giving additional information that the company sold 600 barrels of crude oil in the local market at $100 $10 per barrel, and the exchange rate is also amount. And the company has the posted price, the standard posted price, and the actual posted price is given in there. We just confuse, we don't even know how to get the income, but it's very, very simple and straightforward if you understand it. This aspect have to do with the value of chargeable oil sold. This is derived as by multiplying the number of barrels sold by the company by the posted price of the actual price, which area is higher. Class, I'm explaining this. The company is selling oil, and we call it chargeable oil. If I want to sell chargeable oil, what is the quantity that the number of barrels the company is selling? I have to multiply it by a particular amount called either the actual price or the what? Posted price, or the adjusted posted price. Question now is that what is posted price? Being a what? Multinational companies and being the petroleum sectors, every organization or every company, every countries, they are expected to form a cartels. That cartels, either OPEC, the cartels, yes, normally it has been OPEC based. These cartels now, they have the right to have a fixed rate or the fixed amount in which your oil will be sold. They are expected to sell your oil. Cartel has already fixed their price, which is the price that is always been what? That is agreed between the what? Between the NNPC and the oil exporting companies. Cartel feel the price that for every barrel selling in the international market, it should be $10. Because you have your own crude oil, country, Nigeria, company, Shell, or Chevron, as the case may be, they have their own crude oil. Then I see that this my crude oil is very okay, the quality is okay. So I should be selling more than the $10. That gives you your work. Then you'll be having definitely, you know, the one that the cartel sells, the cartel sets, which is the what by the OPEC, is called the what? The standard posted price. Standard posted price. Posted price is the price free on board at the Nigeria port of export as agreed between the MNPC and the companies operating in the petroleum sector. The posted price is defined as the function of the quality of the crude oil, while the quality of the crude oil is defined by the standard, by the what? By the standard API gravity. That is based on the gravity we determine the quality of the crude oil. Cartels have already set their own standard as it should be $10 every barrel. Because your crude oil has a good gravity and has a good quality, you now want to sell it for $15 and you're able to sell for it that amount. Definitely, there is a what? Definitely, you know, now have the standard price and your own actual price, which you sell at the one set by the cartels. Class, are you with me at all? The question is
sorry.
okay.
API.
Adjusted posted price index is the index,
okay.
API index, adjusted price index. Class, are you with me at all? So this two has been set now. In the question, I have a question in which I have the standard, I have the actual. Which one am I using to multiply my quantity, to multiply the total quality, the total what quantity, which is the barrel? The question says that it has to be the higher between the posted price and the actual price. If you sell for $15 and the posted price is $10, which one is higher? I'm picking $15. $15 should be multiplied. But in some cases, I can prepare adjusted posted price. Adjusted posted price. A question in which I have the standard, I have the actual, I have the actual API, I have the standard API. That is, the standard API is that every 30 degree, it should be sold for $15. My own quality, my own what crude oil is not at what 25 degree or is not at 35 degree based on the gravity and based on the quality of the crude oil. At what price will I sell? Definitely, I'm to prepare an adjusted posted price. I'm to prepare an adjusted posted price. It's not the adjusted posted price I will use to multiply my quantity, or that is the number of barrels I sold, for me to get the income made from the value of chargeable oil sold. Hello. Hello, class. Are you with me?
Well,
you are with me, please. I don't know if you are getting it or.
Yes.
Okay, that's please, Mr. Madam Busola, are you with me at all?
I'm with you, sir.
All right, this is Moji. Thanks. Okay, what I'm trying to say is that in the question, possibility that I will have my own standard. The standard has been given that for every 30 degree, that is every 30 quality, the degree is based on the quality of the oil. It should be sold for $10. My own oil in Nigeria by Chevron, it now has what 25 degree. Will I still sell for $10? No, I have to sell for a reduced price. Now there should be a balancing figure, a balancing amount in which should be recognized as the income made from the sales of this chargeable oil. That will be called the adjusted posted price. Again, set by the question you will see, but it's normally set by the cartels that for every increase or decrease, or for every variances between the standard and the actual, it should be multiplied by a particular indicator of variance amount. Adjusted posted price, I want to get it. But for me to get my adjusted posted price, there should be an amount which is called the what? It's always called the variance adjustments. There's the adjustment price or the variance. It will say for every increase or decrease, for every differences or for every variance between the standard and the actual, make sure it's either you multiply by the particular amount, it will be given. As always said by the cartels. Class, this will bring us to adjusted posted price. And majorly in our question, if value of chargeable oil is not to be tested, you will see this kind of question. Okay, ma'am. Wanted to ask a question.
Can you just say fall down?
Sorry. Okay, class. Look at
it
it now. It's an
illustration
illustration too. Hello, ma, please, your voice. Rahim Oil Limited sold 600,000 barrels of crude oil to his market in Norway for the year ended 34 December 2005. The posted price was $10 per barrel. The posted price was $10 per barrel. Assuming the exchange rate is 141 to $1, the actual price is 1,398. Determine the value of oil sold. How will I know the value of oil sold? It has to be the higher between the actual price and the posted price, provided that the question is not given in form of what? Standard API, actual API. If the question you see an additional information that comes in this way, I have to get the word, the difference between the word, the actual, the difference between the actual, no, I have to get the higher between the actual and the word and the posted price, and that will be the amount I'm selling. That is the amount I'm recognizing. What is the posted price here? The posted price is $10. What is the exchange rate? It will be 141. So $10 times 141, what do I have? I'll be having 1,410, right? Between 1,410, which is the posted price now, and the actual price of 1,398, which one is higher? Look, class.
1,410.
1,410. So I'm using 1,410 to multiply the total quantity of 600,000 barrels, the higher between the two. On the other hand, after doing what? After converting to Naira, and now have 1,000 instead of 1,410, I now have 1,000. If I compare it to my actual, which one will I use now? I'll be using 1,300 and 1,398 to multiply the total quantity, and that will give me the value of oil sold that I will recognize as income when preparing my what? My as computation for petroleum operation. Hello, class, are you with me at all?
Yes, sir.
Okay. Since I need to look at more questions. Look at this. This is where we need to look at very well, and it's very, very important. Illustration. Mercy First Limited. So 750,000. These are like an additional information for you to get your income. Sold 750,000 of crude oil to a market in Jamaica. The standard API class, you've been given the standard API, the adjusted price index of the crude oil is 35 degrees. That is, for every 35 degrees, that is the quality of the crude oil. If it is at 35 degrees, sell for $20. Hello, do you understand what it means? For every 35 degrees, if they measure, if they test the crude oil, and it is up to 35 degrees, it should be sold for $20. That is the standard. It has been agreed that for every rise or fall in the API, which is what I just explained, that in the additional information will be given that for any, it can come this way, for the variance, for differences, for any rise or fall in the API, the price shall rise and fall by what? $1.5. That is, if your actual or is not equal to the what standard, there is difference between the actual and the standard API index. Now it should be multiplied by $1.5. Assuming the exchange rate is $98 to 98 naira to $1, the actual price of crude oil is $10. The actual price of the crude oil is 2,110. Required, determine the value of oil, assuming the actual API is 37 degrees, assuming the actual API is 34 degrees. This is the way your question will come. And if you are able to understand it, you are good to go. Petroleum profit tax, as I said, is very simple. If you understand the format, and one of the formats is for me to get the income. And one way is what? A value of chargeable oil sold. Value of chargeable oil sold. Under the value of chargeable oil sold is the one that will come with adjusted posted price and posted price. Now the question is, how will I get my adjusted posted price? It has been said that if the quality of the crude oil is at 35 degrees, sell for $20. Now, let me assume that my quality of crude oil is at 37 degrees. At what price will I sell? Also, if I'm assuming that my quality of the crude oil is at 34 degrees, at what price will I sell? I've been given that for any rise or fall, that is differences between the actual and the standard, it should be multiplied, that it should also rise or fall by $1.5. Then the question is, how will I get my adjusted posted price? Class, the question is, if the actual API, listen class, if the actual API is greater than the standard API, please add the difference to the standard price. Hello? Class, are you with me at all?
Yes, we're with you, sir.
All right. I say if the actual API, that is, what is the actual API? 37. What is the standard API? 35. If it is greater than the standard, please add the difference to the what? Add the difference. That is the difference, you multiply it by the 1.5 variance, then you add it to 20 degrees. That will give you adjusted posted price. But on the other hand, if the actual is less than, you deduct. Class, let's work this out so we can quickly move to the next one. It says that I want to get my adjusted posted price. For me to get my adjusted posted price, what I'm doing is, what is the API?
Sorry, please, can you come again? If the actual API is greater than the standard, what will
actual greater than standard, add. Actual less than the standard, less.
Okay.
What am I adding? The price. This is my API. This is my price in dollar. Standard. Yes. What is the standard API?
35 degrees.
35 degrees. And at what price?
$20.
$20. It says that for every 35 degrees, it should be sold for what? $20. And what is my actual now? The first one says, 37. If the actual is 37. Class, is 37 greater than 35? Yes. then I need to know the price in which I will sell, which we call the adjusted posted price. What is the difference between this and this? 2. These 2 now will be multiplied by that difference factor, by the variance factor. Go back to the note. It says that for any decrease or any rise or fall, for any variance, if the standard is not equal to the actual, please, what should I do? It says I should do what? It should also rise or fall by $1.5. So this difference now, I will multiply it by $1.5.
Yeah.
2 times 1.5 is what?
3.
3. So class, this is where it comes in. This 3 now, am I adding it to this or am I reducing it to this? Well, that is where I said that if this actual is greater than the standard, I will add that difference. But if the actual is less than the standard, I will deduct.
Yeah.
Madam, do you understand now?
Yes, yes.
So it will give me 23. And the 23 will be, it will be what? This will be the adjusted posted price. 23. It means that I'm selling at 30, I'm selling at 23. The question now is that if I'm selling at 23, and the question has already given me that the company moved. So class, back to our question. The question says that assume the exchange rate is 98 to $1. The actual price of the crude oil is 210. I now need to compare how we convert that 20, for every dollar. I'm selling for 23 now. But the exchange rate is 98. Hello, class. So that 23 times 98, what do I have?
2,254.
2,254. Is it greater than 2,110?
Yes.
Yes.
Definitely, I'll be using 2,254. But if it is still less than this 210, please use 210, the higher of the two, to multiply the total quantity. Now to get the value of my what? Oil sold. Hello, class.
Yes, I will with you.
Are you all with me? So what is
Yes,
the next thing? So what is the next thing I need to do? Then I've gotten my adjusted posted price. Then the value of chargeable oil sold equals to, what is the total quantity? Is it 750?
750,000
times 23 times the exchange rate 98, and that will be the income. Then less your other allowable expenses for you to continue your preparation of petroleum profit tax after you've gotten your income. Areas that are very, very examinable are one, for me to get my income. The income can come from the adjusted price. It can come from the load factor and G factor. It can come from the value of chargeable oil disposed and education tax, then capital allowance. If you are good at this area, please, I don't see the reason why we should fail petroleum profit tax if it comes out, and it will always come out, diet in, diet out. Hello?
Yes, sir.
Okay. For the second one, the standard price, we still have a standard price of 35 at $20. The actual is now how much? How much is the actual? What is the actual price, the actual API now?
34.
34. Is it greater than or less than?
Less than.
What is the difference? 1 times 1.5 is what? The same 1.5. So I will deduct now. I will deduct.
1.5.
So 20 minus 1.5. And what will be the value, class?
18.5.
18.5. This 18.5 now, multiply it by 98. What do I have, class?
1813. 1813.
1813. Is it greater than or less than the 2 something?
Less than.
So definitely, I'll be using 2. It will now be 750 times 2. The one that is higher will be what I'll multiply by the quantity to give me the value of chargeable oil sold.
Okay.
Class, do you understand this?
Yes, sir.
Excuse me, sir.
Okay, sir.
Yes. So now that this computation is lower, so say we'll be using that means we'll be using 2 4,110.
Yes,
right?
Yes.
That's going to multiply with the exchange rate.
You don't need to multiply again. The reason but the question, but this is a working that you must show. You can't just assume that it's lower. You can't know until you do your workings.
Okay, so either way, the workings must be.
You must show workings. For petroleum profit, show all your workings, though. Show all your workings. 1 mark, 2 marks is adding up.
Okay.
If you see question with adjustable stepwise, show the workings how you got your adjustable stepwise. It will be 1 mark. They will surely give you mark. So class.
So now comparing this 18,113 to that 2,110. So you say we're just going to use that value. So
yes, no need of that one has been converted already. You understand? That is the actual naira. The company is in Nigeria already. So this is the amount itself based on the naira 210. But based on the standard and this thing, based on cartels and the rule guiding petroleum, he needs to get his adjustable stepwise and compare it. And that will be what depends. It's just like, these tax people, officials, they want you to pay higher. So you can't tell them you are selling at this. Whether if you have sold at also amount, they will discard the amount you are selling and put the one that is higher. So the next one we look at is the value of chargeable or disposed. Class, can we start here next week? Let's finish here next week and look at the capital allowance, MOU, then pass questions.
Yes, sir.
Or we should continue. If you want us to continue, no problem.
No, let's digest this now.
Petroleum profit tax, please and please, we need to look at the steps one after the other. And we should just be just need to know it, because it will come out. It will always come out. I decided to quickly take it now before the exam will be getting to 2 weeks, 3 weeks, so we won't be having a headache on how to digest or try to get it well to our brain.
Okay.
The class. So we can stop the class here and continue next week, please. So we end the prayer. Hopefully we finish next week. Start on time.
All right, thank you.
Thank you very much. So far, so good. Any question, please? So far, so good. So from the one we've explained. Is it Madam Busola? Any question, ma'am?
I have a question. I have 2 questions.
Huh?
Hello? Can you hear me?
Hello? I can hear you.
Okay, my first question is, the new finance act does not affect in any
The new
way.
finance act does not really have effect on it. Only the Petroleum Investment Act, that bill that was just passed, it has changed everything. Hello, are you with me, ma'am?
I can hear you.
And that one is not examined. It's not. They cannot even test it now because the syllabus has not even covered it. So any question, ma'am?
Okay, yeah, and the last question is, you said something about I got lost where you said you have to use the higher of something.
That you use the this.
When we stopped you said something about we should compare 1.8 something with 2.1.
Yes, what I said was you have to get your adjusted posted price. I've gotten my adjusted posted price at the price of 37 degrees, at APR of 37 degrees. I got my adjusted posted price 23. When I convert it to naira at 98, it gives me 2,005 something. I compare with the actual price of the crude oil, which is 210. The higher between the two is what I will use to multiply the quantity. The same thing applies here at APR of 34 degrees. When I did my adjusted posted price, it was at 18.5 or so. When I convert it to naira, it's giving 1,810. When I compare it to 210, definitely this one is higher. Definitely I'll be using this 2,110 to multiply the 750 quantity, 750,000 quantity or barrel.
Okay, thank you.
Plus, any other question, please?
Yes, sir.
Okay, sir. I can hear you. Ma?
I said,
Sir.
I didn't join the class.
Just
That person's this is like, can you hear me, please?
I can hear you now.
Okay. So, like, I didn't join the class early, though. So maybe you have addressed this. I wouldn't know. But now, in some circumstances, just like a company operating a normal course of business outside PPT, and I've incurred some expenditure that probably this rural development and all of that, maybe within certain distance to the accessible road and all of those infrastructure. So in PPT, how is that taken care of? That is number one.
Okay.
Okay, you can respond to that.
No, number two, so I can maybe it will relate. Just explain it to you.
Okay, then number two, if for instance, I have some of this, okay, like I remember when you talked about this ocean going tanker or something, you said those ones will be taxed under the PPT and CIT, company contracts, right? Okay, so now a company that is in petroleum operation and at the same time carrying out petroleum operation consultancy service for another fellow company. So the income derived from such, will it also be, because it's also in the same petroleum industry operation, but this time around is not for production purpose, but consultancy service or kind of project management that relates to petroleum operation. So would that qualify to be treated under the PPT or CIT?
Hello, sir. For the first question regarding other operations that relates to expenses on needs, if there is a part of it part of the income that should be taxed under SITA, allowable expenses relating to SITA will also be allowed. Are you with me, sir? The allowable expenses. If you see a question that has both PPTA and SITA, let me now assume that the company now has a production expenditure 5 million. Additional information that says part of the production expenditure relates to company income tax for the sum 1.5. What will you do? You relate that 1.5 as an allowable expense under SITA, remove it from the amount from PPTA, and allow the only remaining balance.
Okay.
On the other aspect, there is what we call miscellaneous income. The second question. Under the miscellaneous income, we have income from services provided to other petroleum company. It is part of his what? Income. And it's taxable under petroleum profit tax.
Okay. Back to that question one. Back to that question one. So like if a company have to make route to its point of operation and have to do some probably electrification and all of that. So those expenditure in the Company Income Tax Act, the person is entitled to rural allowance, right?
Yeah.
But in this particular case now, so it's the same thing will also be allowed as part of the expenditure incurred necessary for the operation of petroleum. Is that correct?
Under the petroleum profit tax, what we have is what? The annual allowance. For this to incur all these expenses, is either you classify them as QCE, charge your annual allowance, and if it relates to plant, petroleum investment allowance. Nothing like rural or those stuff of a thing. The only way you can also do is to classify it as part of your cost of sales to reduce your gross profit. And if you have a supporting document to back it up and you can defend it, then it is good. You can pass it as expenses.
Okay, so that will fly as well.
It will. Majorly is how you're able to defend some of your. So we are all accountants. We know how to window dress our account. Some expenses you will incur, and you know that this should not be allowed. But the way you put it in the account, your book, you also determine how the tax official will also accept or not.
Okay. All right. Well clear.
Okay. As a class, we move on from next week, right?
Yes, sir. May I ask one question outside this class, outside this topic, rather?
Okay. Mhm.
Okay, what are the necessary steps to get CAFA? For the purpose
CAFA.
of yes.
Yes. We want to get CAFA. One, your additionals for the year.
Okay.
Your addition for all your additional assets for the particular year. No,
Yes,
no, you
sir.
must have written to a different ministry. There is a
Yes,
ministry
yes.
in charge. You must have written
Yes.
to them. So when you write to them, you send your assets, the additionals for that year, attached with their qualifying supporting documents.
Okay.
When you send it to them, they will send some of their personnel to your office to do fiscal verification.
Okay.
When they do the fiscal verification and they already attested that it's okay, definitely they will give you your certificate, CAFA certificate.
Okay, so that inspection is the only thing they can rely on.
Majorly, right? It's majorly.
The document is just for them to have something to document.
Of course, something I'm claiming for capital allowance. You understand? I've incurred it, and you see that is, you see my support document. Is there another thing you want to ask me? You get that is, and when you want to write, you have to send along with your FX, that page, the fixed asset schedule in your FX.
Okay.
Yes, and it will be signed by the director, one of the directors that signed your FX. It will also be signed by them.
Okay. Okay.
Yeah, it's part of, yes, it should. So fixed asset schedule, it will be signed. Then you can also attach the front page of your FS to show that it is really your FS. And they can also demand for the full financial statements. It depends on their other requirements. The majorly is that inspection. Let them come to the office, look at it. Do you actually claim this asset for QCE? And it doesn't really exist. You know, as an accountant, some organization, some of the assets do not even exist. They are just trying to window dress it, maybe because of loan. You understand? Some organization, they want to get loan from bank. They must make sure that their financial statement, it's okay. Yes, exactly. Okay, any other question, please?
That will be all from my side. Thank you, sir.
All right, sir. So, class, we move on from next week, please.
All right.
Madam Moji, are you with us, please? Madam Busola, please.
Thank you, sir.
All right. Okay, thank you very much. Next week. All right.
Thanks.
Bye.
All right, bye.